So imagine generating over $36 billion in a single year.
Right, a massive number.
Yeah, hitting your absolute highest revenue growth rate in a decade. And then you look at the bottom line, only to realize you haven't made a single extra dime in profit compared to 5 years ago.
It's honestly jarring when you actually lay it out like that.
It really is.
Yeah.
And that is exactly the reality for Medtronic right now. You're looking at a medical device empire, right? They are engineering the future of surgical robotics, cardiac care.
The really high-tech, cutting-edge stuff.
Exactly. And yet their stock has just been trapped in this sustained downtrend, completely disconnected from that top-line success.
Yeah, what's fascinating here is that it's the ultimate case study in what we can call the legacy innovation trap.
The legacy innovation trap.
Right, because you have this massive entrenched market leader trying to pivot a literal ocean liner. But they have to simultaneously pay for the fuel, the structural repairs, the passenger entertainment.
All out of the exact same shrinking margin pool.
Well, exactly. It's incredibly difficult.
Well, welcome to today's deep dive, everyone. We are tearing into a stack of recent equity research and market data, covering Medtronic's, frankly, very complex financial and operational landscape.
Yeah, there is a lot to unpack here.
There really is.
Yeah.
And whether you're, actively managing a healthcare portfolio or you're just trying to understand the grueling mechanics behind how these massive medical innovations actually get funded and commercialized.
That's not cheap.
Not at all. This deep dive is going to reveal the hidden friction in corporate turnarounds. Our mission today is to figure out if this $36 billion giant is finally waking up, or if it's just, burning billions, spinning its wheels in the mud.
Right. Because when a company of this sheer scale, one that touches millions of patients globally, when they start to stall on the bottom line, it sends a very clear signal.
A signal about the broader market.
Yeah, about the rising costs of competing in next-generation medical technology across the board.
So let's just jump right into the core of this paradox. Because the gap between the money Medtronic is bringing in and the money they're actually keeping, it's just staggering.
It really is the first thing that jumps off the page.
Right. So looking at their fiscal year 2026, which ended on April 24th, they reported $36.36 billion in revenue.
Huge number.
Yeah, that is an 8.4% reported growth rate, or I think 5.8% organic.
Which makes it their best growth print in 10 years, by the way.
10 years. Over the last 5 years, they have added roughly $4.7 billion in new revenue.
Right. And in any normal scenario, top-line acceleration of that magnitude, it provides tremendous operating leverage.
Right. You'd expect the margins to just widen.
Exactly. You expect those fixed costs to get spread out over higher sales volumes, so the profit should soar.
But that is completely broken here.
Totally broken.
If we look at their non-GAAP diluted EPS for FY 2026, it came in at $5.53. But 5 years ago, in FY 2022, it was $5.55.
Wow.
Yeah. So they grew revenue by nearly $5 billion, and yet constant currency EPS growth was actually negative 2%. They are running incredibly hard just to go slightly backward.
And we really have to remember that $5.53, that is the non-GAAP figure.
Right, the adjusted number.
Yeah, that is management's preferred smoothed-out narrative. When you look at the GAAP earnings, the actual unadjusted accounting reality, the EPS drops to just $3.73.
I am looking at that GAAP to non-GAAP chasm right now, and it's wild. Their GAAP operating income was around $6.4 billion. But it gets absolutely mauled by nearly $3 billion in depreciation, amortization, and these massive restructuring and separation costs.
Yeah, the restructuring costs are the real anchor here.
I understand normal business expenses, but $3 billion, that's a massive drain. What exactly are they restructuring that costs billions of dollars while failing to move the EPS needle?
Well, this is exactly how that legacy innovation trap functions, right? Medtronic is undergoing a massive, expensive internal renovation.
Okay.
When a legacy company spins off less profitable divisions, or they separate entirely integrated business units like they've been doing with patient monitoring and respiratory interventions, it isn't just a matter of signing some paperwork.
Right. You can't just flip a switch.
Exactly. You have to physically disentangle global supply chains. You are duplicating IT infrastructure that used to be shared.
Oh, wow. Yeah, I didn't even think about the IT side.
Right. Plus, you're paying enormous severance packages, retooling factories, and amortizing the premiums you paid for past acquisitions.
So it's like, okay, let's unpack this. It's like you just got a massive $5,000 raise at work, right?
Okay, yeah.
But the new commute, the higher tax bracket, and the lifestyle inflation ate every single penny of it, leaving you basically poorer than before.
That is a perfect analogy.
So where is the actual leverage? Where's this $4.7 billion in new revenue going?
Right. The leverage is basically being consumed by survival. Their older, traditional product lines are facing severe pricing pressure globally, which, oh, we will get into that later with China.
Right, yeah.
But to counteract that, they are forced to invest heavily in the high-growth, high-margin technologies of the future.
Because if they don't, they just become obsolete.
Exactly. But in the short term, they are funding that transition by cannibalizing their own cash flows. They are spending their new revenue just to stay relevant in a rapidly evolving surgical landscape.
And because of that massive $3 billion drain, it severely limits their options.
Yeah.
Which, really forces us to look at the balance sheet.
Yeah, you have to look under the hood.
Because if the earnings aren't accelerating, how is Medtronic actually managing its capital? Are they funding this transition responsibly, or are they mortgaging their future?
Well, the balance sheet reveals a company that is very heavily leveraged. And in a macroeconomic environment with, elevated interest rates,
Right.
leverage is not the cheap, easy growth engine it was a decade ago.
No, the debt load is heavy. Over the past 5 years, their long-term debt jumped by nearly $6 billion. It's sitting now at $26.1 billion.
It's massive.
And total debt is nearly $28 billion. Against that, they have just $9.2 billion in cash and short-term investments.
Right, so that leaves a net debt of about $18.7 billion.
Exactly. And you can see how the market is discounting this, because their enterprise value is roughly $128 billion. But the actual equity market cap is only $109.3 billion.
And carrying $28 billion in debt, it completely changes a company's strategic playbook. When your debt service costs are that high, you lose your agility. You just do.
Boy, I'm looking at their free cash flow, and it's actually solid. They generated $5.4 billion in free cash flow for FY 2026.
It is solid, yeah.
Yet they're still throwing a massive chunk of that cash at their dividend. They just raised it to 72 cents a quarter, which makes it their 49th consecutive annual increase.
Right. Yielding about 3.4%.
Yeah, yielding 3.4%. I have to push back on this strategy, though.
Okay.
Is this a sign of financial discipline? Or is this just a corporate board utterly terrified of losing their dividend aristocrat status and sparking a mass sell-off from institutional yield chasers?
Honestly, it is largely the latter. And it perfectly illustrates the bind therein.
Really? So they're trapped by their own dividend?
Absolutely. Institutional dividend growth funds mandate consecutive increases.
Right.
The second Medtronic pauses or cuts that dividend, those funds are literally forced to liquidate their positions.
Which would just crater the stock price.
It would crater it. So by maintaining that sacred 49-year streak, they are earmarking a massive portion of their cash flow before they even think about R&D acquisitions.
Wow. It feels like they are renovating a sprawling mansion entirely on high-interest credit cards, but they are still giving the kids a bigger weekly allowance every single year just to keep them from throwing a tantrum.
Yeah, that's exactly what it is.
I mean, they have a net debt-to-free cash flow ratio of about 3.4 times. It restricts everything.
Precisely. Because of that 3.4 leverage ratio, large-scale debt-funded acquisitions of disruptive new medical startups are essentially off the table.
Right.
A decade ago, a company like Medtronic might have just bought their way out of a growth slump by acquiring 3 or 4 cutting-edge robotics firms.
Just gobble them up.
Exactly. But today, doing that would threaten their credit rating and explode their interest expense. And they don't have the dry powder for aggressive stock buybacks to artificially boost that stagnant EPS either.
Which means they are backed into a corner. They can't just buy their way out of this, and there is a limit to how much restructuring they can do.
They actually have to invent their way out.
Right. They have to win organically in high-margin, innovative sectors. Which brings us to the actual operating room. This is where Medtronic is trying to prove this turnaround is real.
And this is where we separate the financial engineering from actual clinical value, because to grow earnings, you need products that command premium pricing and capture dominant market share.
So let's start with their cardiac advancements, because this is historically their bread and butter.
Oh, absolutely.
In early August, they announced that their Affera mapping and ablation system, specifically utilizing the Sphere 9 catheter, it just won an expanded European regulatory approval for treating ventricular arrhythmias.
Right, the CE mark.
Yeah, and it already holds a breakthrough device designation in the U.S.
So cardiac ablation is a highly complex, very lucrative procedure. When a patient has an abnormal heart rhythm, surgeons map the electrical signals in the heart and then use a catheter to basically scar or destroy the specific tissue causing the misfire.
Okay, but how does this specific system, the Sphere 9, actually change the economics for a hospital? I mean, why is it a needle mover for Medtronic?
It changes the economics through throughput and precision.
Throughput, meaning speed?
Exactly. Traditionally, mapping the heart and then ablating the tissue required switching between different specialized catheters.
Oh, so you'd have to physically pull one out and put another in?
Yeah, which takes time. The Sphere 9 is designed to do both high-density mapping and pulsed field or radiofrequency ablation with a single device.
Wow. Okay, so if you reduce the time it takes to map the heart and switch tools, you reduce the time the patient is on the table.
Right, and if a hospital's electrophysiology lab can safely perform, say, 5 ablations a day instead of 3.
That margin profile of the entire hospital wing transforms.
Exactly. Medtronic is betting that this dual capability will command premium pricing and rapid adoption.
That makes total sense. Efficiency translates directly to hospital revenue. But cardiac care is just one pillar, right? Medtronic is also pouring massive capital into the future of general surgery, specifically robotics.
Yes, their robotic-assisted surgery system, Hugo.
There you go. They've recently filed regulatory submissions to expand Hugo's use into general surgery and gynecology.
Expanding those indications is critical, because a hospital is not going to spend millions of dollars on a robotic system if it can only be used for a very narrow set of urological procedures.
Right. It just wouldn't make financial sense for them.
Exactly. General surgery and gynecology represent the highest volume of routine surgeries. Winning those indications turns Hugo from a niche tool into a multi-purpose workhorse.
Which accelerates the hospital's return on investment.
Precisely.
But I have to stop you there, because when you talk about robotic surgery, there is an absolute monopoly in the room.
Yeah, there is.
Intuitive Surgical and their Da Vinci system. I mean, they completely dominate the operating room globally. Is Medtronic's Hugo system just playing in an incredibly expensive, futile game of catch-up here?
Look, displacing Intuitive Surgical is arguably one of the most difficult challenges in the medical device sector right now, and it all comes down to the mechanics of switching costs.
Yeah, let's talk about those switching costs, because it's not just about which robot has a better camera, right?
No, not at all.
It's like asking a commercial airline pilot who has flown a Boeing 737 for 20 years to suddenly land an Airbus A320 in a thunderstorm.
That is a great way to put it.
The pilot knows how to fly, but the instrument panels, the feedback, the muscle memory, it's all different. In an operating room, when a patient's life is on the line, that loss of muscle memory is a massive liability risk for both the surgeon and the hospital.
It is the perfect analogy. The switching costs are structural and psychological. First, you have the capital expenditure cycle.
Right.
If a hospital system just dropped millions outfitting their surgical suites with the latest Da Vinci models, they are locked in for years. They are not going to just rip those out to try Hugo.
Especially not when budgets are tight.
Exactly. And second, an entire generation of surgical residents has been trained exclusively on the Da Vinci interface. Medtronic isn't just selling a piece of hardware. They have to retrain the surgeons, integrate with the hospital's existing IT networks.
Oh man, the IT again?
Always the IT. And they have to prove that the clinical outcomes are at least identical, if not better.
So Medtronic is fighting this uphill battle against an entrenched competitor. And according to the data we're looking at, they are doing it while facing brutal macroeconomic headwinds.
Yeah, it's not just Intuitive they're fighting.
The sources specifically highlight Chinese volume-based procurement policies, or VBP, and sector-wide tariffs.
Right, and you really have to understand how VBP fundamentally alters the competitive landscape.
Okay, break that down for us. What exactly is VBP doing?
So volume-based procurement is a centralized purchasing policy where the Chinese government aggregates the demand of public hospitals, and basically forces manufacturers into a blind bidding war.
Wait, so they essentially turn high-margin, specialized medical technology into a commoditized utility.
Exactly. It forces companies to make a brutal strategic choice. You either slash your prices, and I mean often by 60, 70, or 80%, just to win the contract and maintain your manufacturing volume.
80%, that's insane.
Yeah. Or you refuse to bid low, and you instantly lose access to one of the largest healthcare markets in the world.
Wow. So for a company like Medtronic, VBP just crushes the margins on their legacy devices.
Right, which forces them to rely even more heavily on unproven next-generation tech like Hugo to make up the difference.
Because they need the premium pricing from the new tech to offset the losses in China.
Exactly. Add in global tariffs, increasing the cost of raw materials and electronic components, and you see why that gap operating margin is under so much pressure.
Okay, so we have the product pipeline laid out. We see the heavy financial baggage, the dividend trap, the massive switching costs in robotics, and these margin-crushing procurement policies.
It's a lot.
It's a ton. So how is the market currently digesting all of this? How are investors actually betting on Medtronic's future?
Well, the current sentiment is a fascinating study in contrast, really, between the public markets and the insiders.
Yeah, the public price action paints a picture of total exhaustion.
Yeah.
The stock is trading around $87.16. It is down over 9% year to date, and it's sitting roughly 18% below its high from November 2025. I mean, it recently bounced off a June low, but the trading volume on that bounce is incredibly weak.
Right, and when you see a technical bounce on low volume, it signals a complete lack of conviction from institutional investors. The broader market is basically sitting on its hands.
But the insiders are absolutely hammering the buy button.
Yeah.
This is the biggest twist in the data. Over the trailing 90 days, company executives and insiders have purchased over 1.2 million shares with their own cash.
Over 1 million shares.
Yeah, 32 separate buy transactions compared to only 20 sells. And short interesting, the percentage of the float actively betting against the stock is microscopic. It's sitting at just 1.49%.
That divergence is everything. Insider buying of that magnitude is a massive table-pounding vote of confidence.
Well, why? It's because they work there.
Think about the mechanics of executive compensation. Insiders receive stock options constantly. They will sell stock for a myriad of personal reasons, diversifying their portfolio, paying taxes, buying real estate.
Sure, yeah.
But they only take their own liquid cash and buy shares on the open market for one singular reason.
Which is?
They have internal visibility that the turnaround is taking hold, and they believe the current share price is mispriced by Wall Street.
So the insiders see the internal metrics for the Sphere 9 rollout, they see the Hugo adoption rates, and they are buying.
Right.
But Wall Street is ignoring them. Why the disconnect?
Because institutional investors have been burned by the turnaround is just around the corner narrative with legacy healthcare companies before.
So it's a trust issue.
Exactly. Wall Street is in strict show-me mode. 5 years of stagnant EPS destroys trust. Portfolio managers are not going to allocate massive capital based on executive optimism.
Right.
They're going to wait until they actually see the earnings beat printed in black and white on a quarterly report.
Which brings us to the ultimate crucible for this company. Their Q1 FY 2027 earnings report, scheduled for late August 2026. This is the moment of truth.
It really is. It is the exact moment the market needs to see the bottom line proof.
Well, the company's own forward guidance is laying out expectations for organic revenue growth between 6.75 and 7.25%.
Right.
And alongside that, a non-GAAP EPS target in the $5.90 to $6 range.
Right. And if they hit the midpoint of that guidance, you are looking at roughly a 7% EPS growth rate.
After 5 years of essentially 0% growth.
Exactly. Hitting that $5.90 to $6 mark in late August is the proof of concept.
Right.
It proves to the market that the $3 billion in restructuring costs are finally fading. It proves that the $4.7 billion in new revenue they generated over the last 5 years wasn't just, empty calorie growth.
Right, that it actually translates to profit.
Yeah. And it proves that the Afra mapping system and the Hugo robotics platform are scaling profitably despite the pressures of Chinese VBP and global tariffs.
So bringing it all together, you have a medical device titan sitting at a historically critical inflection point. They boast their highest top-line revenue growth in a decade. They are pushing the boundaries of cardiac ablation efficiency, And they are aggressively expanding a surgical robotics platform into high-volume indications.
Yeah.
Plus, they have nearly a half-century streak of raising their dividend,
Yeah.
and their own executives are buying stock hand over fist.
But balancing that scale, you have a company bogged down by $28 billion in debt. They're navigating an absolutely brutal global pricing environment, trying to unseat a robotics monopoly where the switching costs are incredibly high.
And fighting to explain a baffling 5-year stagnation in profit growth to a very skeptical market.
Exactly. It all comes down to that late August 2026 earnings report. That print will determine if the legacy innovation trap has finally been broken, or if the heavy machinery of this transition is just going to keep chewing up their profits.
Right.
It is a watershed moment, and honestly, it leaves me with a lingering question that extends far beyond just Medtronic's balance sheet.
Okay, what's the question?
Well, we're analyzing a legacy giant that has maintained its dividend for 49 consecutive years while attempting to completely rewrite the rules of robotic surgery and cardiac care. Right.
Right.
But looking at the broader horizon, what happens to the entire healthcare industry when artificial intelligence, predictive diagnostics, and fully autonomous surgical robotics become the baseline standard rather than just a novel exception?
Yeah.
Can massive, heavily embedded legacy corporations pivot fast enough to dominate this incoming era of medicine? Or will smaller, agile, unburdened tech disruptors ultimately bypass them and take over the operating room entirely?
That is the structural question that will define the next decade of medical technology. And it's definitely something you, the listener, should be keeping a close eye on as this sector evolves. A huge thank you for joining us on this deep dive. Keep questioning the mechanics behind the market data, and we will catch you next time.